US President Barack Obama has signed into law the biggest overhaul of American financial regulation in decades. And now the US begins the long road to implementation of the Dodd-Frank Wall Street Reform Act. FIG Securities Managing Director Jim Stening joins us now in studio, and of course Carson Scott still with us for Market Express. Jim, great to have you on board. It's signed into law today. It's a long road ahead, but what's the impact or the effects you've seen already so far?
Yeah, well, there's a lot to unfold here. It's something that will play out over a number of years as the minutiae is defined. But one thing that we noticed is the predicament, I suppose, that the rating agencies currently find themselves in. I think there's probably two aspects of that. One is that this too big to fail, I suppose, this systemic support that has existed in the past for large organisations, they have to take that into account when they're looking at the ratings of those institutions. And the other thing is that there's some new liabilities that they incur, or some new responsibilities that they incur when they're providing their research to investors.
Okay, so there is quite an impact for them. Have they been able to put their hands around just what it means for them, though, entirely?
Well, not really, because I think in between the upper house and the lower house passing this law, there was a change, and one that I think may have wrong-footed them a little bit.
It's interesting you say wrong-footed, because looking at the timeline, as you rightly say, things were shaken up a little bit in between, getting a debate on this and a final bill signed into law. There was, as I understand it, though, a telephone conference of all things, Moody's chief exec telling investors that they were concerned back in April about unintended consequences. So there was a red flag then. Is it right that they can claim or cry foul now if they thought it might happen back then?
I suppose probably not, but given that it wasn't included in that first draft, I suppose they can point to that. But what it does mean is that, and I suppose the consequence is that recently the rating agency have asked new issuers not to include their research in the offer document. So once that document is lodged with the SEC, that opens a potential for liability for the rating agencies in their view.
Well, how can that offering then get off the ground?
Well, that's right. I think what we've seen is that there's been whether it's coincidence or I think it probably has largely to do with this occurrence, is that we've seen particularly asset-backed securities. There's been no issuance this week, and those securities by law are required to be rated. So therein lies the problem.
Well,
so do they have to change that?
Well, exactly.
Well, I think it may be that they need to just change the way or the modus operandi in terms of the way they communicate their ratings, or how they go about providing them. So I think, interestingly, this hasn't really had an effect on the underlying equity price of those rating agencies, but it has caused confusion in the capital markets.
Is it kind of an oversight? I mean, to be left, as you said, this week, no new issues. I mean, how long would that go on for?
I guess it's symptomatic of what's to come. I think when you have these sweeping changes across every aspect of financial services and financial markets, there are going to be unintended consequences. And I think, given that there is this prolonged implementation plan, we're going to see these little hiccups along the way.
Can the SEC, though, force them to issue their ratings? Because they mandated that select grouping from day one, if you think back in time, right?
Yeah.
So as a kind of, well, you get the hallowed position, you don't sit on the sidelines. Yes, you've got more responsibilities, but you've also still got to keep working.
Well, I think that's why the rating agencies are going to sit back and look at what parts of the market they want to be involved with. I mean, I'd like to think the SEC's, they're not that dictatorial, but yeah, I think it does mean that things are going to change.
Okay, let's look at some of the other implications. Businesses, how are they coming to grips with it, do you think, in terms of other, maybe unexpected effects of this Act? Yeah,
well, I think really, this will all play out over time. I think, fundamentally, it's going to impact on the financial services industry, and there's a broad range of changes.
Can we just bring matters as well back home to the domestic bond market now, pricing in on the back of minutes this week from where you sit, Jim, and also on the inflationary front with the CPI print crucial.
Yeah.
What are bond markets saying is going to happen in August?
Well, I think there's probably, I have to say, a minority that think that rates are going to go up.
That hasn't changed since the minutes were released?
No, I don't think so. I think interestingly, if you look at Bernanke's speech last night, it was relatively opaque. I think one of the good things about developments with the Reserve Bank in Stephen's era is that it's become very transparent. It's a very welcome development, and I think, you know, really they had, you know, it does come down to the CPI. I don't think anyone is in any doubt that if that is over and above the expectations or broader expectations of the Reserve Bank and the market, that we are going to see a tightening in Australia. So, you know, that's really where we are.
Yeah.
We just heard earlier, Carson was mentioning TD Securities coming out saying they think there's going to be kind of an unexpected blowout in inflation, and of course that'll put pressure on the RBA to move mid-election. Some of the other details, what were they mentioning?
Yeah, well, they were basically talking about the annualised rate running potentially at its highest level now in 18 months. So they're saying, look, if we get a 1% on quarter print, which admittedly they are, as you know, Brooke, always in that camp that's probably at its most bearish. If you get a 1%, so that's uncomfortably high on quarter, to take the annualised rate now at 3.4%, that's blowing out.
Yeah, that would not be a comfortable outcome, no.
More than that, it would be an unsustainable outcome, right?
Well, it would warrant immediate action. I mean, and I suppose people would start to factor in, you know, the consequences of longer-term outbreak of inflation.
And it's that curious thing again, is it not, about how low unemployment, which is what we have relative to the US, can actually come back to bite us on things like rates.
Well, it could do. I mean, interestingly, though, there are some things in the US economy that are happening here as well. And, you know, interestingly, Bernanke, one of the things that he's really been focused on is this rationing of credit, particularly to small business. I mean, if they're going to do anything about their unemployment rate, that needs to be addressed, and obviously that's why I think their adjustments to unemployment have been.
But isn't it the interesting thing that he continues to allow regional banks to close down every weekend, and they are the ones that lend to that very space you're talking about.
I suppose, but by their disappearance, that exacerbates the problem. I think what we are seeing here is we're starting to talk about independent rate increases. We're starting to talk about rationing the credit to or continuation of rationing the credit to certain sectors, shrinking of banks' balance sheets. Those sorts of things are present here. So it's an interesting.
It doesn't. I guess one of the messages out of Bernanke overnight, though, it seemed to be that he's not on the front foot. People are feeling he's waiting to react, and you know, you talk about, oh yeah, they're looking at, you know, ways to support business. Well, the unemployment rate's still up there, and they're talking about it, but why aren't they doing anything? I mean,
I suppose the luxurious position the US is in is that everybody buys US bonds when things turn bad elsewhere in the flight to quality. It's a very in terms of their funding their deficit, it's very cheap for them to do that, particularly when you're paying 0.5% for 2-year money.
Yes.
And just speaking of which, on everyone buying bonds, just to clarify, with this reluctance and refusal now of the ratings that we were talking about to issue new ones, are they also refusing to put a rating on sovereign debt, let alone corporate?
I don't think so, no. And secondary market analysis, I think, is alive and well.
Okay. So
good stuff.
Bernanke can rest easy. Obama can rest easy.
Jim Stening, thanks so much for joining us yet again from Victoria.